In this chapter, we're going to focus our attention, obviously, on dividend policy. Our focus is going to be on what this has to do with the firm's value. With that in mind, let me explain why this matters by returning to the model of the firm. You remember when we were talking about the model of the firm, we said that the firm is really, the key to success is balance. And it's balance because we're looking at the needs of two completely separate markets. Most firms start out by focusing their attention on the market for goods or services. Shoe companies would be looking at the need for shoes. Restaurants would be looking at the need to eat. Those are the markets that they're working in, whether it's a market for goods or services. The owner, the founders, would come up with some business idea where the goods or services would be produced that they believe that the market is demanding. That's their concept. I have this way of producing goods and services that the market is demanding. In return for these really good goods and services, the market will give me money. And they're looking at how much they have to pay for how good a quality they're getting. Because of that, I have to have good business processes in place that can produce high quality goods for a competitive price. Those business processes themselves demand certain assets, whether it's inventory, whether it's land and building, whether it's desks and computers. There are certain assets that all businesses require. Because we're funding assets, that brings up the other market, the market for debt and equity, which is the focus of all finance courses. We're looking at this second market, the market for debt and equity. The business itself can't run without being able to fund those assets. Those assets come through the market for debt and equity, and money gets injected into the business based on perceived risk and expected return. The business processes themselves that generate the goods and services and produce those sales will eventually be able to throw off some cash. That's the portion we're talking about in this particular chapter, is how much of those dollars come back in the form of actual dollars from the company. That is called a dividend. Dividends are specifically a tangible return on investment, repayment to shareholders for equity investment in the company. Years ago, I was teaching an investments course in a retirement community, and in the back of my class were two retirees. They reminded me of the two guys in the balcony in the old Muppet Show who would sit and make comments regarding what was happening on stage. So I felt like Kermit the Frog in the front, and with these two old guys in the balcony who were making comments all during my lecture. They'd usually come up afterwards, though, and say, here's what we were talking about. One of the things that they mentioned was that they had just been investing in the market because they were retired. They had cash. This was a retirement community. They had been burned in the .com bust, which had just happened when I was teaching this class. And they told me at that point that they would never invest in a company that didn't pay at least something in dividend, because the dividend was their signal to them that they actually were making a return on their investment, going back to the earlier model. This dividend is cash from the business, from their cash flow, to current shareholders. Dividends have to be declared by the board of directors, and if paid, dividends are typically paid quarterly. If they're paid on a regular basis, it's generally quarterly. The boards of directors will declare the dividend, and they can't just declare, oh, we're going to be paying them quarterly from now on. They actually have to meet and say, okay, we have the money, we have some cash, let's declare so much in dividend per share. And when they make that declaration, it's called the declaration date. They will also tell you when you had to be a holder of record to expect a dividend. Those after that date typically are considered, if you trade the stock before that date and the new shareholder can become a holder of record by the holder of record date, then great. If not, you're buying it ex-dividend. So generally, if they can't get you to be registered by the holder of record date, you realize you're getting this particular stock without any claim on any dividends. Let me give you an example of a declared dividend. Caterpillar is one of the members of the Dow Jones Industrial Average. Shouldn't say members, but it is a stock that is part of the Dow Jones Industrial Average. Let me get up here. On October 8th, 2014, Caterpillar's board of directors voted to maintain the quarterly cash dividend of 70 cents per share of common stock. It would be payable on November 20th, 2014 to stockholders of record at the close of business on October 20th. In other words, after October 20th, for sure, if you buy the stock, even though the dividend isn't going to be paid until November 20th, you will not get the dividend. It's only those people who owned it on October 20th who will get the 70 cents per share. But the last paragraph is rather interesting as well. Caterpillar has paid higher dividends to its stockholders for 21 consecutive years. For 21 consecutive years, they have increased their dividend. The company's cash dividend has more than tripled since 1998. Including the announcement today, Caterpillar has paid a cash dividend every year since the company was formed and has paid a quarterly dividend since 1933. That's a very long history of paying dividends. But not all companies can pay dividends. And some of the reasons why they can't pay dividends, there may be some debt covenants. If the company actually has done some financing either using bonds or other types of debt, there are sometimes covenants within those. For instance, the bond indenture itself may not allow them to pay a dividend. And quite often, debt covenants say that if your cash flow ever gets below a certain level, and usually it's a ratio of some sort, then you have to suspend your payment of dividends. Preferred stock restrictions. Sometimes if a company offers preferred stock, the common shareholders sometimes can't get a dividend if preferred shareholders, for instance, aren't receiving one as well. There is an impairment of capital rule, which basically says if you have 0 retained earnings on your balance sheet, you can't be paying a dividend, because that would put you in negative retained earnings, because that's what you're paying it out of. And by the way, I'm not really saying that the money on your equity or retained earnings side of your balance sheet is actually cash. It isn't. The only thing that's cash on your balance sheet is the line that says cash. What I'm saying is you can't pay dividends that will reduce your equity below that retained earnings line. And so companies really are constrained to pay dividends only if they're making money, or turning a profit, I should say, not making money. The fourth one is the availability of cash. If you don't have any cash, you can't pay a dividend, because dividends that we're talking about, at least at this point, are paid in cash. And finally, this one is a reverse constraint. The tax penalty on improperly accumulating earnings. Some companies decided that the best thing to do for their shareholders is not pay a dividend, because their shareholders were kind of higher earning and higher tax bracket shareholders, and therefore what they really wanted was long-term capital gains over which they had complete control when they actually recognized them. The problem with waiting around and just accumulating earnings is the IRS sees this as avoiding taxes, because dividend income can be taxed. And so in lieu of just accumulating the earnings, the IRS is saying, if you're just accumulating the earnings, no, that's not going to work, and we're going to charge you an extra tax penalty for doing that. And so this is listed as a constraint because it's a constraint on not paying a dividend. If the company's earning cash and not reinvesting it, they need to find some way of employing that cash, and if they can't, they really kind of have to declare a dividend. So when and how much should firms pay in the form of a dividend? Remember, the ultimate goal of a financial manager should be to maximize shareholder wealth. Shareholder wealth can be maximized by maximizing the price of the stock. As you may have learned earlier, the price of the stock is the expected present value of all future cash flows. One of the early implications of this was the Gordon growth model that we covered in Chapter 7. That model is looking at discounting the only cash flow that comes directly from the company, which is the dividend. Whether or not that is useful in determining firm value, and is the only useful thing in determining firm value, is a matter of debate. That debate started with Myron Gordon. In the late 1950s, Myron Gordon proposed a model, the Gordon growth model, to price a firm's stock based on its dividend and its potential for growth. And this is the one that we derived back in Chapter 7. Price at time 0 is equal to the dividend at time 0 times 1 plus the growth rate in dividends divided by the cost of equity minus the growth rate. Now, because we have the growth rate in both the numerator and the denominator, and as G gets bigger, price gets bigger, there is an interesting dynamic going on here. Because if you look at the formula, d sub 0, if we get d sub 0 to be as big as possible, that will increase p sub 0, the price at time 0. However, at the same time, if we have G get as big as possible, the price at time 0 will also expand. Now, the problem that we have with both of those statements is they tend to contradict one another. As we've already pointed out, you can't declare more dividends than you have in retained earnings. Therefore, I'm kind of constrained on how much d sub 0 can be by how fast I'm going to grow. If I'm growing, I'm going to reinvest and reinvest and reinvest and reinvest. And if I don't have the cash after doing all my reinvesting, I can't pay a dividend. If I'm not making enough money so that I'm actually going to be retaining sort of in the hole, then I'm also not able to do that, and I have a problem. So from Myron Gordon's perspective, the optimal dividend policy is to maximize price, and optimal balance must be found between the current dividend that I'm paying, d sub 0, or even the expected dividend, d sub 1, and the need for growth, G. A few years after Gordon published his paper on the valuing of shares, two researchers, Merton Miller and Franco Modigliani, showed algebraically that dividend policy didn't matter. And I'm going to show you this algebra in just a sec, so bear with me as we cut through some algebra and some mathematical logic as we try to figure out what they were saying. They showed that as long as the firm was realizing the returns expected by the market, meaning they made them and then they reinvested them in the company or paid dividends, didn't matter. It didn't matter whether they returned the money in the form of a dividend or reinvested. As long as we were looking at present value issues, they said that it really didn't make any difference. So the amount of dividends itself didn't matter. The shareholder can create their own dividend if they need to by selling the stock when the cash is needed, and they'll just retain the piece that they don't need at the present time, and then essentially they can create their own dividend. The bottom line with Miller and Modigliani is, or was, that the actual dividend policy run by the company should be irrelevant to the stock price. If dividends don't matter, this chapter, in fact, becomes irrelevant as well, which is what most of you are thinking probably anyway. Bear with me, therefore, as I work my way through the logic of their algebra. So here we go. Take a deep breath. We're about ready to do some algebra. Okay, we can do this. Dividend irrelevance. Here's the theory. And by the way, I'm using their notation, so if this looks a little weird, it's because this is the notation that they used pretty much. So V sub t is the value of the entire firm at time t. Is equal to 1 over 1 plus r sub t. We're just doing a one-period model. They eventually will expand this to a multi-period model in their paper. I'm not going to go there. I'm just wanting you to see the initial dividends don't matter conclusion, and if you're really interested, you can go take a look at Miller and Modigliani's original paper, which is pretty much just algebra. The other kind of interesting thing is Miller and Modigliani were Nobel Prize winners in economics, partly because of this. So 1 over 1 plus r sub t, so we're discounting the following. Total dividends paid during time period t, plus we get the value at t plus 1, so that's when we sell it, minus m sub t plus 1 times p sub t plus 1. And the first time I looked at this, I was going, what in the heck is that? Well, just a second, I'll get to that. By the way, the p sub t plus 1 is the price per share, and the m t plus 1 is the number of shares we had to sell during the time period. But I'll get to that in a sec. So we have r sub t is the discount rate, d sub t the total dividend paid, v sub t plus 1 is the firm value, the total firm value, which is going to be n sub t plus 1 plus p sub t plus 1. Now the n is the total number of shares outstanding, whereas m is just the portion that we had to sell from time t to time t plus 1. Okay, so because of that, n sub t plus 1 is the same thing as the number that we had to begin with, that's the stuff that I invested in to begin with, plus the amount that I needed to raise during that time period. So what in the world is this amount that I had to raise? Well, the amount that I had to raise would have to be the amount that I needed to invest, that's the I sub t, minus the difference between what I made and the amount I declared as a dividend, just because that's kind of what I have to do. Based on that, therefore, I should be able to take that I sub t minus x sub t minus d sub t and put it in place of the mt plus 1 times pt plus 1. I'm just going to substitute it in. This is algebra. Therefore, making the substitution that we've already indicated would lead us to this equation. The value of the firm is the discounted dividend, value of the firm after a period, and all of the other junk essentially that we said, the investment, the earnings, minus the dividend. Oh wait, we have dividend in there twice. Therefore, notice how the dividend on one end cancels out with the dividend on the other, and we're just left with V sub t, total firm value at this moment, is equal to the discount of the value of the firm minus investment plus earnings. Note, dividends aren't in the final equation. Therefore, dividends are irrelevant to value of the firm or the stock, according to Miller and Modigliani. What is important, however, is earnings, investment, and value. I should, to be honest, say Miller and Modigliani, like any good economist, made some unrealistic expectations or assumptions in developing their model. Brokerage costs didn't exist. Taxes didn't exist. In other words, they lived in a different universe than we did. They made these assumptions just to simplify the analysis, and because of that, they opened up a debate. So Myron Gordon, not wanting to concede quite yet, had an argument that reminded me a lot of my retirees in my earlier investment class. He said that if you have the dividend, I'm going to think that that's a lot less risky that I'm ever going to get paid back than if I don't have the dividend. It's called the bird in the hand theory. So Gordon argued that a dividend in the hand's worth more than the discounted future cash flow, future dividend in the proverbial bush, because it's less risky. If we take Gordon's model, the last one, where it had the P sub 0 is equal to the D1 over R sub S minus G, and we solve for R sub S, we get this relationship. R sub S equals D hat 1 over P sub 0 plus G. It can be shown, and we don't have time to do this, but we could do this algebraically, and I never want to push too much algebra on people because some people actually have the algebra illness, and so I'm going to not actually force you through the algebra here. But as it so happens, that G in this particular situation will show you that the G is showing you how fast the actual price will increase. Not only the dividend will increase at that rate, but in the Gordon growth model, that suggests that the price is also expected to grow at that same G, which means that the G in this particular instance and in this particular context is the capital gains yield, whereas the D1 over P sub 0 could be seen as the dividend yield. And what Gordon actually said was the higher proportion of the total yield that is in dividends, the less risk premium you need for stuff we don't know is going to happen in the G. In essence, he was suggesting that the risk premium on the two components of the equity return are different, meaning that it's if you have more of a return in the dividend component, it's much more certain, and therefore the overall R sub S would go down. In addition, because they didn't want to give up either, Miller and Modigliani showed that taxes may make a difference because we tax, and for many years we completely taxed, dividend income differently than we would capital gains income. And therefore, there were three ways in which taxes affected the dividend preferences of shareholders. First, individual investors' tax rates may differ for capital gains and dividends, which they did for many, many years, which made it inherently better for most shareholders to get capital gains than it did dividends, because capital gains, long-term capital gains taxes were far less than dividends. Taxes on capital gains are not due until the stock's sold, which means that I get to choose when to recognize that particular tax. And therefore, if I'm making tons of money right now, I may wait until I'm making very little or negative amount and then realize that capital gains. If the stock's held until the shareholder expires, by the way, no taxes are due from that shareholder at all, except in perhaps estate taxes, but since you're dead, who cares? For years, the capital gains rate was significantly below the dividend income rate, prompting many companies to retain more income, declare smaller dividends, no matter what would have been preferred any other way by their shareholders. The tax code made them prefer less in dividend. Then in 2003, George Bush II shepherded through the Jobs and Growth Tax Relief Reconciliation Act, and the dividend tax rate fell sharply. What happened after that, almost immediately after that, is there were several companies that decided, up until now we really haven't paid a dividend, but it doesn't look like it's that bad of a deal. For instance, dividend tax cut signed into law by President Bush in late May already is leading some publicly traded companies to boost the dividends they pay shareholders, hoping it will help the share price. Why? Because Gordon was right, according to them, at least in their own minds. And even those that can't afford to offer much in the way of dividends may find a way to benefit from other parts of the tax law changes. Last week, Goldman Sachs, Bank of America joined the companies that have jumped on the dividend bandwagon. Goldman, last week, more than doubled its dividend. B of A raised its quarterly dividend 25%. One of the first companies to anticipate the dividend tax cut was Microsoft Corporation, which announced its first ever annual dividend of 16 cents in January. This seems to suggest that at least the corporate CEOs at the time saw some value in Gordon's theory that their dividends did matter, and as soon as we reduce the tax, the inordinate amount of tax on dividends, that maybe that mattered a little more than we had anticipated. So in short, do shareholders prefer dividends or capital gains? Well, the dividend irrelevance theory would say dividends don't matter as long as I'm earning the market's return on investment, and my shareholders can then sell the stock when it comes time to sell it for the kind of return that they are expecting. Dividends don't matter. The bird in the hand theory, though, says no, actually that's not true. The more you put in dividends now, the more I believe you're actually getting that return and not playing games with your accounting books. And then the tax preference theory is saying, well, that may be true, but it's a little ambiguous as to whether we have bird in the hand happening or dividend irrelevance happening, because the tax laws kind of muck things up. So based on these three theories, we could get a different story as to where our optimal dividend policy should be. The first of these tweaks came from the original paper from Miller and Modigliani. It says it may look like dividends matter, but what you're actually seeing is what they call the clientele effect. Now, the clientele effect, from Miller and Modigliani's standpoint, meant that tax-free foundations and retirees, lower marginal tax rates, prefer cash now and on a predictable basis. If you ever cut their dividends, they're not going to be happy. They're going to sell the stock, and if that's what the company's shareholders are made up of, it's going to look like dividends matter, even if they don't. Investors at a higher tax rate might prefer capital gains to dividends. With capital gains, they can better time their own tax liabilities, and so under that instance, a company that has a clientele of shareholders who are looking for capital gains, if you increase a dividend, if you start paying a dividend when you didn't used to pay a dividend, all of a sudden they're saying, I don't like this. I'm actually going to sell my stock and buy one that isn't doing this. And therefore, using clientele effect, companies that suddenly start paying dividends could actually reduce the value of the stock by paying dividends or increasing them too much, because I don't want that much in dividend income. Each firm, according to Miller and Modigliani, therefore attracts the type of investor that likes its dividend policy. And if you start changing up your dividend policy, you're sending a message to the market, which brings us to the second tweak. The second tweak to the theories is called signaling. The theories themselves have assumed that investors and managers have the same information set, meaning that I know as much about the prospects of the firm as the firm management does. Signaling says, well, it's probably not true. The managers probably have a better idea as to what they're going to be earning later in the year than I do, who's outside the company and don't have all of the information. Therefore, if I start adjusting dividends in weird ways, the shareholders and participants in the stock market will use that information to imply different things about the prospects of the company. Those things could be very different from what the management wants to convey, however. For instance, if you increase your dividend, that may be a good thing in some instances, but if the market says that you're increasing your dividend because you don't have any projects in which to place it, therefore your growth rate's going down, therefore the G in that formula is going down, they'd go, no, I don't think so, and the stock price would actually go down with an increase in the dividend. That's kind of counterintuitive. So an increase in dividend could go either way. An unexpected decrease in the dividend is pretty straightforward. It says you don't have the cash, you don't have the prospects for cash in future, and you're readjusting to let me know that. Remember, this becomes incredibly critical because of the clientele effect. With the clientele effect, that cat woman down the street who is, or cat man, don't want to be sexist, down the street who is living day to day on their dividend income, if all of a sudden the company that I have all my stock in cuts their dividend, all of a sudden, well, Fluffy's looking really good for an after dinner snack. You know what I'm saying? And because of that, rather than eat Fluffy, I think what I'm going to do is sell my stock and see what I can get for it and buy a company that is going to pay me a regular dividend. So when you cut the dividend, you are sending a specific message that you don't have the cash and you don't care about your shareholders, or you care more about your own survival. The bottom line is you're sending a very bad signal. It's therefore believed that firms do not increase dividends beyond Wall Street's expectations unless managers anticipate stronger earnings than expectations. And you never, ever cut your dividend. The other thing to note is it's only unexpected changes in dividends that relay information to the market. If the market expects that change in a dividend, it usually makes no difference in the stock price because the analysts on Wall Street have already anticipated it. That's the end of this segment of this chapter, where we talk about all of the theoretical stuff. The next chunk we're going to talk about is applying this to a real company, which basically says, so how does this translate into dividend policy? How can I tell what dividend policy seems to be used in a company? And then based on that, how can I use that to try and get my first shot at what the company's stock should be trading at?